What if the next global financial meltdown isn't coming from the stock market or even from real estate, but from a shadowy corner of finance that has grown to trillions, largely invisible to the public? Legendary investor Jeffrey Gundlach, known as the Bond King, is sounding the alarm. He warns of hidden risks, garbage lending, and a fragile system where liquidity could vanish overnight. Few are paying attention, and yet the next big crash may already be brewing. Jeffrey Gundlach didn't earn the title of Bond King by chance. As founder and CEO of Double Mind Capital, he built a reputation for navigating treacherous waters, generating wealth in fixed income markets when others panicked. But today, his gaze isn't fixed on treasuries or conventional bonds. It's on private credit, a largely opaque market quietly ballooning into a trillion-dollar giant. Private credit is, at its core, lending outside traditional banks. It provides capital to companies that can't access standard loans or bond markets. It includes direct lending, mezzanine debt, and other structures that bypass the scrutiny of regulators. Over the past 2 decades, the market has exploded. Once a niche investment, it now touches the portfolios of pension funds, endowments, and wealthy individuals alike. And with its growth, Gundlach sees danger. He warns that this market shares eerie similarities with the subprime mortgage bubble that triggered the 2008 financial crisis. Loans are being packaged in ways that obscure risk. Leverage is increasing. Redemption rights for investors are often paired with assets that are nearly impossible to sell. And when a liquidity crunch hits, the losses could be catastrophic. The rise of private credit is tied to several forces. Following the 2008 financial crisis, traditional banks pulled back from risky lending. Meanwhile, institutional investors sought higher yields in a world of low interest rates. Private credit funds filled the gap, promising attractive returns while operating outside conventional regulatory oversight. This combination of demand, growth, and limited oversight has created a market both alluring and dangerous. Gundlach has referred to segments of this market as garbage lending. He has observed deteriorating underwriting standards, looser covenants, and excessive leverage in deals that once would have been considered too risky. In his view, many of these loans are highly illiquid, yet are marketed as safe investments. The structural mismatch between promised liquidity and the actual nature of these assets is a ticking time bomb. What makes private credit so volatile is its opacity. Unlike public bonds, these loans are rarely marked to market. Valuations rely on internal models, infrequent assessments, and manager discretion. If a wave of redemption requests were to arrive, the market could face a cascade of forced selling, plunging valuations, and widespread losses. Gundlach warns that a system built on illusionary stability can collapse quickly, often faster than anyone anticipates. He points to the human and institutional consequences of such a collapse. Endowments, pensions, and sovereign funds that assumed stability could be blindsided. Companies relying on private credit to operate and expand could find their lines of financing suddenly unavailable. Jobs could be lost, projects halted, and the ripple effects could touch the broader economy. For Gundlach, the warning is clear. Investors must prioritize liquidity and transparency. He has shifted allocations toward assets that are more visible, regulated, and liquid. While he acknowledges that not all private credit is inherently dangerous, he cautions against complacency. Yield chasing in opaque markets can blind investors to the fundamental risks lurking beneath the surface. The stakes extend beyond Wall Street. If a private credit crisis unfolds, its shockwaves could affect ordinary markets, borrowing companies, and the global economy. Regulatory authorities are aware of the risks, yet the growth and complexity of private credit have outpaced oversight. The very design of these funds, lockups, redemption structures, and illiquid underlying assets creates the potential for systemic instability. Gundlach's message is not one of fear for fear's sake, but of awareness and preparation. History shows that financial crises often arrive unexpectedly, hiding in corners least monitored. Private credit, with its opacity, leverage, and rapid growth, may be the next frontier where risk accumulates unnoticed. For those who heed his warning, there may be opportunity, but only for those who act with discipline, patience, and caution. Ultimately, the story Gundlach tells is one of both warning and wisdom. The private credit boom has unlocked capital, fueled growth, and delivered returns, yet it carries fragility, a silent threat beneath its shining promise. Investors, institutions, and policymakers alike face a choice: understand the risk and act prudently, or be caught off guard when the next crash emerges. Quiet, yet devastating. In the end, Jeffrey Gundlach reminds us of an enduring truth in finance. Not all returns are created equal, and not all markets are as safe as they appear. The next crisis may not make headlines immediately. It could unfold quietly, in private corridors of capital, in a market most people cannot see. And when it does, the consequences could be severe.